I welcome you once again to Executive Masterclass Tutorial Center. Please, we are located at Ashoman Estate, A-Line. Today will be our 7th section when it comes to the consolidated financial statement since we started. So today, as I told you during our last discussion on part 6, I told you that we're going to solve questions on the consolidation so that it will make you know that based on our sections, our videos that you have been watching, you are good to go when you want to tackle any consolidation question. So today, I would like us to tackle a question that is from Institute of Chartered Accountant Ghana, their March date 2025, question 1. So the question will be placed as when it comes to the first comment, our video on YouTube. The question will be posted there, so you can download it, or you can also get a question or access to the question. Also, you can also follow our Telegram page where the question and the video also will be posted. So the link for our Telegram page will also be posted under this video. So when you go to YouTube, you can get access to the question, and also you can enjoy watching our exclusive videos that we have uploaded on our YouTube channel. So let's start this question. So the question, we're going to start by any time you are coming to do a consolidated financial statement question. What that you have to think about is that you need to read the requirement of the question. Then after that, you have to also check on the 5 basic workings that you need to know. Then you proceed on with that. But I can give you some tips. In a case where maybe you are doing it during your exam time, I can assure you that if that you go by some specific steps, it will help you to make you get everything on time. Or you can, because you know that consolidation is very broad. When you are doing it, it needs some time for you to complete it. So I can tell you that if that you are doing it in your book, what that you can do is that first you can, if that you are doing, let's say, consolidated financial statement for, let's say, the income and the income statement. What that I would like you to do is that first, let's say, just bring the name of the company or the group. Then you bring your consolidated financial statement, let's say, whether for income or this one. So you bring everything up, the topic. Then let's say that one will be on the first page. Then if that you have been asked to do the consolidated statement of financial position, that one too can be another page. So your income statement and comprehensive income will be on the first page. You go to the second page, then you just draft your income, your statement of financial position also there. Then when it goes to your page 3, then you can start with your 5 basic workings, starting with your group structure as your workings 1. You come with your, so beneath it you can have your net assets of the subsidiary also there. So you doing all these things now, let's say on the second page you have gotten your group structure, you have gotten your net asset of the subsidiary. You go to the 4th page, then your 4th page you can have your goodwill as workings 3. You bring your net NCR reporting as workings 4. You bring your data of your this one also as well, the group retained earnings. So when you've been able to put all this stuff on your paper, then I bet you that when you are doing it, you can run at let's say a good pace whereby you can complete your workings and everything on time without wasting much time, or maybe finishing with the workings, then you go to the question itself. Because even though the workings will be marked, but the question, what that the question is actually is what that is supposed to be marked properly. So because of my board, I will be starting with the 5 basic workings on this question. Whilst I'm reading it, I'll be solving it, so that when you get a question, then you are following with the video, you understand it proper. So the requirement of the question that I'm going to have with you, Institute of Chartered Accountant Ghana, March 2025, their question 1, which is always the consolidation. Okay, so the question that we're going to tackle, it says that prepare for ABBA Limited a consolidated statement of profit or loss for the year ended 31st December 2024, and consolidated statement of financial position as at 31st December 2024. So we are going to do for profit and loss, and also we're going to do for statement of financial position. So we need to go through like the process that I first told you. If that you have your books, you just draft everything, then you are good to go. So let's move on by going through the question. Let's see how that we can bring up some other stuff. So let's say we can bring up with that of our group structure as this one. So let's read the question and let's see what the question is saying. Okay, so the question says that ABBA Limited, a technology company, acquired 60% of the share capital of Boafo Limited on 1st January 2024. So now our date of acquisition here is what? 2024, and the company which has acquired 60% is what? ABBA Limited, from that of what? Boafo Limited. So here with this we can just even what? Draft our our group structure. So the group structure, let's say the workings one. So group structure. So the name of the company which is acquired is what? ABBA Limited. So ABBA Groups. Let me bring that one first. Hope it's double A. Okay. ABBA Limited. So let's say ABBA Groups. Then let me bring the first working, which is what? The group structure. The group structure. So the group structure, they're saying ABBA Limited has, which is what? 60% shares of Boafo Limited. So Boafo Limited will be having what? 40%, which is that NCI. So this one will be our group structure. Then we bring our date of acquisition. So date of acquisition, they said 1st January 2024. So 1st January 2024. Then date of reporting. That one too is what? They say 31st December 2024. So here we can know that our post-acquisition period is what? 1 year. Yeah, so this one will be our group structure. Don't come to this because maybe when you are reading the question can tell you that maybe there will be an associate. So you bring the associate also here. Then you add up by bringing the date that they acquired the associate and also any post-acquisition period. And also the date of reporting. That will help you to get the post-acquisition period. So these are some of the things that we need to do when it comes to the group structure. So first reading this, you can be able to just draft your group structure. You can be able to draft your group structure. So continue with it. The question says that there are two elements to purchase consideration: a share exchange transaction of 3 shares in ABBA for every shares acquired in Boafo. So like I said, when you check from my previous videos, I told you that when it comes to this aspect, the question will be telling you how that the consideration transfer is going to be done. So I've let you guys know that we have 4 ways that an entity can acquire an organization. So here the question is telling us that there is there is a share exchange. There is a share exchange. So the share exchange will be part of the group will be part of the consideration transferred. So now, because of this info, let me bring here, let's say our workings 2. So the workings 2 will be the net asset of the subsidiary. So the net asset of subsidiary. The subsidiary is who? Boafo. The net asset of subsidiary. So I'll bring all those stuff here. Let me bring the workings 3 here. Goodwill. Goodwill. Then so let me, anything that I read and there is anything, I will just bring it up, then we follow up with that. So they are saying that when it comes to the goodwill aspect, that's where this one comes in. So they said that there is a share exchange. So the consideration transfer, we're going to have share exchange. So share exchange. And the share exchange, they are saying that it is what? The share exchange is of 3 shares in ABBA Limited for every For every 5 shares acquired in Boafo. So we know that we have acquired 60% shares. So what that we have to do is that we need to come and have, if you want to find the this one, we need to bring our what? The 60% shares that we have here. Then if you want to know the number of shares that we have acquired, therefore, in this question, we need to go to the equity side of what? The equity side of the subsidiary. So when you go to the equity side of the subsidiary, we are going to see there's a number of shares, the equity shares. So the share capital here is what? 1 cedi per ordinary share. And the subsidiary is having 35,000. 35,000 Ghana. So it means that per, if that you want to know the number of shares, it's 35,000 shares because one share is what? 1 cedi. So when you multiply 35,000 by 1 cedi, it is giving you what? 35,000 shares. Or when you want to know the number of shares, assuming in the question it was not 1 cedi, but it was what? 0.5 pesos. Therefore, you need to divide the 35,000. The 35,000 is in monetary terms. So you need to divide by 0.5 to give you the number of shares. Then you can come and use it. But here, since that the price per share is 1 cedi, therefore it means that the 35,000 shares is equal to the number of shares that the subsidiary is having. So we have acquired 60% of it. So you bring 35,000 here. Then you multiply it by the share exchange. They are saying that the share exchange is what? 3 on 5. 3 on 5. So let me say it clearly here. That's what the question is saying. The share exchange is what? 3 shares in ABBA Limited for every 5 shares. And as I told you, anytime there is a share exchange, since that it is the parent which is what? Issuing the shares, therefore, the share exchange should be multiplied by the share price of what? The parent. So in this question, they said that, let's say there is a cash also consideration of 20.4 million on the date of acquisition. We will come to that after the share exchange. So the share price of ABBA at the date of acquisition was what? 1.2 Ghana cedis per share. So here is what? Times what? 1.2 Ghana cedis per share. So when you multiply it, will give you the number of shares that the parent is what? The amount of shares that the parent has. So 0.6 times our 35,000 shares of the subsidiary. 35,000 shares of the subsidiary. Multiplied by the share exchange of 3 on 5. Then we come up with the share price of the parent is 1.2. So this one is giving me 15,120. 15,120. So this one is the share exchange. And when I was reading the question, they also made mention that there was what? They also issued what? A cash consideration of 20.4. A cash consideration of 20.4. And they also have given us the share price of the parent, the share price of the subsidiary, which is what? 1.015 Ghana cedis. So that one, it will come later because you are not going to use that one to do our calculations here. So let's bring the cash consideration, which is another cash consideration transfer. So cash consideration. They said it's 20.4 million. So let me, assuming all workings are in what? In thousands. So let's say all workings are in thousands. Therefore, let me bring up with this idea of 2,400. Yeah, so 2,400. So if there is any other cash, let's say consideration transfer, you bring it up. So let's see how it goes. So this one just gives us from the first paragraph, it has helped us to get a group structure. We have been able to also get some of the transactions for the goodwill. So let's continue. So in the question, they have given us the summarized draft financial statement of both companies. So we have the sales revenue for ABBA and also Boafo. We have cost of sales, we have gross profit, admin expenses, finance costs, profit before tax, everything is here. So when you have the question, as I told you, you get everything clearly there, so you can base on it to make your analysis. Then the statement of financial position of both companies has also been given to us. So the 35,000 which from the subsidiary was picked from the statement of financial position at the equity side. That's where you get the share exchange aspect. We have everything, the non-current asset, the current asset, the equity, and also the non-current liability, as well as the current liability component. So these are the stuff that we have here. So now let's go to the additional information of the question. Let's see how the transaction is going to be done. So the first additional information that we have here is saying that the fair value of Boafo net asset were equal to their current amount at the date of what? Acquisition, with the exception of plant which was valued at what? 4 million. So this one I've always been telling you that anytime you are doing consolidated financial statement, probably these things will come in. So this one will come under when you are doing your net asset of the subsidiary. So let me bring this one up so that you guys will get it correct. So the net asset of the subsidiary, as I said, I always say, you have to bring your date of acquisition. So date of acquisition. You bring date of reporting or reporting date. Then you bring your CDs and the other aspects. So as I said, all workings are in 1,000. So what that you have to do is that you have to make sure you are bringing the share capital of the subsidiary. The share capital of the subsidiary. So let me hope since that we are done with the group structure, let me bring up the net asset at the top so that we can get everything correct. Yeah, so let me bring that one top so that everything will be seen clearly. So I hope you saw how the group structure was done. So that's how you're supposed to go by. So the workings too. Net asset. So date of acquisition, date of reporting, so like I said, all workings are in 1,000. So okay, so you bring your share capital. When it comes to the net asset of the subsidiary, we are just concentrating on only the subsidiary side. So when you go to the statement of financial position, you'll be seeing some figures under equity, which that is beneath the parent, which that is beneath the subsidiary. Sorry. So Boafo is what? Is the subsidiary. So the share capital of the subsidiary, which is what? The when it comes to the equity side, we have 35,000. So as I always tell you, the 35,000 will come here. The same thing will come here. Then in the question you check whether maybe there is revaluation, there is share premium, all those things you need to bring it. But in this question, when you check under the equity side, the only thing that we have here is retained earnings as at 31st December 2023 and retained earnings as at what? 31st December 2024. So the 31st December 2023 one will be the opening retained earnings, and that one is 5,000. That one is 5,000. So retained earnings. Is 5,000, and the closing one is 31st December 2024. The figure 2 is what? 8,600. So for you to get the closing one, you need to add the opening retained earnings with the closing. So 8,600 plus the 5,000, which is giving us what? 13,300, 13,600. So 13,600. This one will be our retained earnings at reporting, and the 5,000 will be at what? At opening. So that's it for that. So let's continue. If that is in it, let's go to the additional information so that we can come and do the adjustment on what they are saying about when it comes to the net asset of subsidiary. So the additional information is saying that the fair value of Boafo, the subsidiary, the fair value, when you go to the market, some of how that they are selling some of the items or the asset that the subsidiary is having. So the fair value of the net asset of the subsidiary were equal to their current what amount of the date of what at the date of what acquisition, with the exception of with the exception of plant, which was what valued at what 4 million below its current amount. So when you go to the market, there is some asset that the fair value there is below what that they have recorded in their books. It means that in their books they have recorded it higher. The plant is higher than when you go to the market, how much that they are selling it. So what that we need to do is that anytime it comes to this, they say it is plant. So plant. So you come and do what? You bring the plant, since that it is what? Below the current amount. It means that they have charged higher. So we need to come and subtract it. So 4,000. 1,000. You need to come and subtract because they have charged higher in their books. Don't forget that anytime you see plant like this, probably there might be a depreciation. And if there is a depreciation, you need to also check on it that if the post-acquisition period was less than 1 year, it will have effect on it. But this one, it was 1 year direct. So let's see what they will be saying about the depreciation aspect. So they also said that depreciation at the remaining useful life of the plant is 4 years, and the period has not changed as a result of the acquisition. Depreciation of plant is on straight line basis and charged to your cost of sales. So this any depreciation you calculate here will be charged to cost of sales. So depreciation. So you bring the depreciation. So depreciation. So depreciation. They said it's 4 years. The remaining useful life is 4 years. So you divide it by 4 years. If that there was something like the post-acquisition period or less than 1 year, it will have effect here. But here it was directly this one. So you just need to. It was directly 1 year, so there will be no 6 months or any 8 months or any 9 months. So you get it direct here. So you divide the 4 years by, you're going to have 1,000. So you bring your 1,000 here. So it means that these two figures, when you go to the group consolidated statement of financial position, you write these two as part of it. So whether you can do by deducting the 1,000 from the 4,000, and you can write the two there. So when you go to the equity, the property PPE side, you bring 4,000 minus 4,000 plus 1,000 to it. So that's how the calculation is going to be. So it goes to the consolidated statement of financial position. These two figures will go there. So then the question is telling us that we should charge the depreciation as part of cost of sales. So when you are doing our income statement, we have to go and add this one as But you see this one is positive. So it will be deducted from the cost of sales. This figure is positive, so it will be deducted from cost of sales. If that it was a negative figure, if that was a negative, it means that maybe it means that the depreciation that they charge here is it's more, because when you go to the market, it is less. So you just have to come and do the adjustment. So this figure will be added to the cost of sales, but it will not be subtracted because it's a positive depreciation. Okay, so so let's go on by reading some of the other notes and let's see what the examiner is saying. So when you go to the note II, the examiner is saying that in the post-acquisition period, Abba sold goods to Boafo at a total value of 4.6 million. So the parent has sold some goods to the subsidiary. Anytime the parent sells some goods to the subsidiary, therefore it comes with that of intra-group trading. And according to IFRS10 business combination, they are saying that there should not be any reason why there shouldn't be any way whereby the parent and the subsidiary will be trading among themselves. So if there is any intra-group trading, we need to eliminate it. So in this case, the subsidiary has sold goods to the parent has sold goods to the subsidiary, which is 4.6 million. And one thing that you need to know is that anytime that it comes to intra-group trading, the whole figure, which is the revenue, which is the sales, which that in this question, it is 4.6 million, supposed to be subtracted from revenue and also subtracted from cost of sales. So when you are doing the workings, you know that we have to subtract the 4.6, which is the total revenue, the total goods that the parent has sold to the subsidiary, from the revenue and also from the cost of sales. The 4.6 will be calculated from that. And the other thing is that you see, it is the parent who is selling to the subsidiary. Let's see what is next. The parent has sold goods, this is 4.6 to the subsidiary. Let's see what is next. If that the subsidiary was able to sell all the goods or not. So in this case, they are telling us that the goods cost 3 million. The goods that the parent sold to the subsidiary, the parent sold it 4.6 million. But the goods actually cost 3 million. So it means that the parent is making a profit of around 1.6 million. So in this case, they are saying that during the year, Boafo has sold 2.5 million out of the 4.6. So the parent has sold goods of, let's say, 4.6 million. And in the books of the subsidiary, in the books of, let's say, the parent, the goods cost 3 million. So it means that the parent is making a profit of, let's say, 1.6 million. But the 4 million has been given to the subsidiary. And the subsidiary has issued the goods. The subsidiary is having a 4.6 with him, but what that they have done is that they have been able to sell 2.5 of it. So 4.6 minus 2.5. So let's see how how many goods that is still with the subsidiary. So 4.6 minus 2.5, you're having what? 2.1. So 2.1. So 2.1 million goods is still with the subsidiary. And in some cases, when it comes to this issue, it means that the parent has already recorded a profit that is supposed to get from this 4.6 million, but 2.1 million is still with what? The subsidiary. So because of this issue, what that we are supposed to do is that the parent is not going to recognize all the money. So we need to go and what? Deduct it. So when you go to the group retained earnings of the parent, that's where that we do that workings. That's the workings 5. You need to go and adjust it by bringing what? Provision for unrealized profit. Provision for unrealized profit comes in, whereby the parent sells some goods to the subsidiary, and the subsidiary was not able to sell all the goods. Therefore, the profit margin, the profit that the parent has placed on the goods, that one we need to come and what? Deduct it from the group retained earnings, because the parent is not going to what? Receive all. In other way around, maybe it might be the subsidiary which has sold some goods to the parent. When it comes to this issue, whereby the parent was not able to sell all the goods, therefore the provision for unrealized profit calculation that I'm going to do is going to also be calculated, and it's going to be subtracted when it comes to the net asset of the subsidiary. If that these goods were sold by the subsidiary to the parent, and there is some of the goods still with the parent, therefore the provision for unrealized profit will come here, and we need to come and deduct it, because the subsidiary is not going to receive all the profit on the goods sold. So that's it for that. So in this case, let's see how the PUP is going to be. So the PUP, the provision for unrealized profit, that will be taken to the group retained earnings, and it will have impact also on our cost of sales, as well as when it goes to our inventory, it will have impact on it. So as I first told you guys, this 4.6 million will be deducted from revenue and also will be deducted from cost of sales. Let's see what is next when it comes to the provision for unrealized profit. So what we're going to do is that we're going to bring in more cases, maybe the examiner will give you a percentage. Whether the examiner will tell you that, oh, the subsidiary, let's say, the profit on the goods sold is, let's say, a markup of 25%. So if that the examiner told us directly the markup figure or a percentage as a markup, therefore, what we need to do is that this one is a selling price figure. This one is a selling. Therefore, we should have what? Converted the markup to margin by doing 25 over 125 times this 2.1. Because this one is the remaining goods with the subsidiary, so that we can get the PUP. Or in a case where the examiner gives you the profit in the margin, let's say there's a margin of what, 25%. That one you need to come. You don't need to come and change it to a markup, because this figure is already in the selling price mode. So you just have to apply the 25% on the 2.1. If that it was what? At margin. But in a case where it is at what? Markup, you need to change it. So we need to also know that. But in this case, there is no